Hello, welcome to Chapter 9 where we're going to be talking about responsibility accounting. Companies can be centralized or decentralized. Decentralization is when we allocate responsibilities to the actual managers that are responsible for those areas. And in order to make sure that everybody's tracking to plan, we look at responsibility reports. Responsibility reports prepare budgets for each responsibility center. They measure performance of each responsibility center, and timely performance reports are prepared and compared actual with budgeted amounts. Here's an example of what responsibility reports look like. So you can see that there's different levels. Here's Parent Holding Company, and they're looking at the furniture manufacturing division. You can see that there's different companies, 3 different companies that make up the furniture manufacturing division. The table incorporated is going to have a further responsibility report that talks about the controllable expenses only for that department. And you can see it's broken out even further into different departments. Here we see Table Incorporated's production department and the detail that makes up their total variance. So depending on what level manager you are, you may get one or all of these reports. This introduces the concept of managing by exception. So what does that mean? Basically what it's saying is that a manager is not going to look at every single variance that exists. Lower level managers are going to receive the detailed reports, and the level of detail increases at higher levels. So if a problem arises, top management gets a highly summarized report, and they can request greater detail to look into the problem. Basically, they're managing by exception because they're only going to get involved in the detailed operations if a problem arises, okay? And it has to be a material problem. They're not going to look at every immaterial problem. The controllability concept talks about how managers should be evaluated based on how well they manage controllable costs. That means that they should only be judged on the costs that they can actually control and have power and influence to determine how those amounts are incurred. For example, production managers are generally considered to be responsible for the amount of material used in their departments, but not for the cost of the insurance on the building in which their departments are located. We have 3 different types of centers when we're looking at a company. There's a cost center, which strictly has costs, and their responsibility is to manage those costs. An example would be human resources or the accounting department. They don't sell any external products to incur revenue. A profit center has both revenues and expenses, and they're assessed based on their profitability, how profitable they are. And finally, an investment center has revenue, expenses, and they're able to make investment decisions. So they can make decisions about entering new projects, selling new product lines, or purchasing long-term assets. And they're measured based on return on investment or residual income. This is what we're going to spend the rest of the time talking about. So first we're going to look at return on investment, also known as ROI. Return on investment is the ratio of the income that you generate to the investment used to generate that income. So typically we're looking at operating income as a percentage of operating assets. We want to look at how much income we're able to generate. So here we have a company with 3 different business lines: lumber manufacturing, home building, and furniture manufacturing. And we've been given their operating income and operating assets. So let's look at calculating their ROI. Which one has the highest ROI? It would be the lumber manufacturing company. All other things equal, a higher ROI indicates better performance. So if the overall company had additional funds to invest in one of these 3 centers, they would most likely invest in the lumber manufacturing. Basically what that means is that for every dollar of assets that they have, they're generating 20 cents in operating income. Using the book value of operating assets to calculate ROI is going to result in a higher ROI. That's because you're using a lower amount of assets, therefore increasing the ROI. Managers will consider comparisons between different investment centers unfair because the ROIs do not accurately reflect performance if one center is using acquisition cost and another is using book value. So you want to make sure that you're being consistent in how you're measuring your ROI and how you're calculating your assets. So there's two different factors that affect ROI. Therefore, sometimes it's helpful to take a more detailed look at ROI by considering the two additional financial ratios that are components of ROI. A company's margin, or profit margin, is defined as operating income divided by sales. Their asset turnover is sales divided by operating assets. So you can see that the ROI formula simply cancels out the sales and becomes operating income divided by operating assets. When we multiply our margin by our turnover, it gives us the ROI. Why do we break this down further? Well, basically, it helps us understand what components of our ROI is really driving the ROI, and it helps us compare to different divisions or companies better. So we'll know if the margin is really what's affecting it or the turnover. Let's look at an example. Again, we're going to be looking at the lumber manufacturing division, and we've been given the additional information of their sales. So we're going to do the extended ROI formula, and we're going to come up with the same ROI of 20%. We're going to take our operating margin, which is 10%, times our asset turnover of 2 to get an ROI of 20%. So there's three ways to improve ROI. We can look at increasing our sales, reducing our expenses, or reducing our operating assets. Okay? By doing any of these three things, we would improve our ROI. So let's go back to our lumber manufacturing division. And in this case, the division manager is able to increase their sales to $660,000, which also increases their operating income to $72,600. And the operating assets are unchanged at $300. So what do you think is going to happen? Is the ROI going to increase or decrease? Let's look at the extended formula. Now we have a new margin of 11% and a new asset turnover of 2.2%, which gives us a new ROI of 24.2%. They were able to do two things. They were able to increase their sales and increase their operating income. Therefore, it increased their overall margin as well as their turnover because their invested assets, their operating assets, stayed the same. ROI has some drawbacks. It's sometimes criticized because it can lead managers to make decisions contrary to the best interests of the overall company. For example, suppose you're the manager of lumber manufacturing division. ROI is used to evaluate your performance and determine your annual bonus. The company requires an ROI of 20% on all invested funds. Your division has been producing an ROI of 30%, well above the company minimum. You're presented with an opportunity to invest in a new project that will produce an ROI of 25%. As a division manager, would you invest in this project? Well, probably not, because as the manager, the 25% return is less than your overall return of 30%. Therefore, you'd have a reduction in your bonus. However, the project overall would be more profitable to the operations of business. So thereby, by doing what's best for your personal interest is not necessarily what's best for the overall company. That's why we introduce another point of measurement, referred to as residual income. So residual income is another performance measure, and it's looking at your operating income above some minimum return on invested capital specified by the company. So the dollar amount of the minimum ROI is called an investment charge. You can see that the investment charge subtracted from operating income will get you the residual income. It might help to look at an example. So here we have the lumber manufacturing division again, which currently earns $60,000 of operating income with $300,000 of operating assets it controls. the company has a desired ROI of 18%. So let's look at our calculated residual income. First, we're going to calculate the desired income by taking their operating assets times the ROI, which gives us 18%. Then we're going to compare the desired income of $54,000 to our actual income of 60%. So we actually have a positive residual income of $6,000. So whenever we have a positive residual income, that means that our ROI is actually greater than the desired ROI. So if you remember to our original example, lumber division had a 20% ROI, which is higher than the 18%. So we would expect to see positive residual income. The residual income approach encourages managers to make investments that are profitable to the entire company, but might be rejected by managers who are evaluated using ROI. So it avoids the drawback of using solely the ROI measure. As always, please reach out to me with any questions that you may have. Thank you.